Welcome to The Explainer. Today, we're popping the hood on one of the most famous, Nobel Prize-winning valuation engines in modern finance, the Capital Asset Pricing Model, or CAPM for short. If you've ever wondered how financial pros take something as abstract as risk and magically turn it into the hard number returns we use to value assets, well, you are exactly in the right place.
It really all starts with a pretty fundamental investing question. How do you put a price tag on risk? I mean, the golden rule is always that higher risk should mean a higher expected return, right? But if you're looking at a new stock or a huge new project, how do you actually measure that risk? And exactly how much extra return should you be demanding for taking it on? We literally need a system to figure that out.
So, to get to the bottom of this, we'll quickly map out the risk-return problem, peek inside the actual CAPM formula, plot out the security market line, look at how to price a specific individual asset, and finally, go over some major real-world criticisms. Let's break down the math and see how this determines asset returns step by step.
All right, let's dive right into our first piece of the puzzle, the risk-return problem, and how investors actually classify risk.
Basically, the risk of any portfolio is split into two buckets. First, you've got unsystematic risk. This is the quirky, idiosyncratic risk specific to just one company. Think of a CEO suddenly resigning or a massive product recall. Then you've got systematic risk. This is the big, unavoidable market risk that hits everybody, like inflation or global geopolitical events. Now, the absolute brilliance of CAPM is its ruthless focus. It assumes rational investors will only expect to be rewarded for systematic risk. Why? Because the market isn't going to pay you a premium for that unsystematic risk, since you could have easily just diversified it away for free by holding, say, 30 to 40 different securities in a developed market.
Now, figuring this whole thing out didn't just happen overnight. Back in the swinging 60s, economists like Traynor, Sharpe, Lintner, and Mawson all independently arrived at this exact framework by building on earlier modern portfolio theory. It was such a massive paradigm shift that William Sharpe literally won a Nobel Prize for it in 1990. Oh, and a quick nod to Fisher Black, who in 1972 developed the Black CAPM, which is this highly influential zero-beta variation that didn't even assume a perfectly riskless asset existed. Okay, let's actually open up the hood of this valuation engine and see how the math works to determine those asset returns. The formula itself is elegantly simple, relying on just three main ingredients. First up is the risk-free rate, usually just the yield on a safe government bond. Next is the market expected return. Now, the difference between those two, that's your market risk premium, which is basically the fuel of the entire model. And sitting right there in the middle, multiplying that fuel, is beta.
Think of beta kind of like a financial thermometer for volatility. And the number 1? Well, that is our baseline temperature. By definition, the broader stock market as a whole has a beta of exactly 1.
So if an asset has a beta greater than 1, it's simply riskier and more volatile than the market average. Less than 1, it's a bit more chill and less sensitive. Ultimately, a high beta stock forces the CAPM formula to pump out a much higher required rate of return. And this is exactly how the model takes raw, abstract volatility and translates it into a specific required yield, proving what we intuitively know. Investors absolutely demand higher returns for holding riskier assets. Moving right along, how do we take that expected return we just calculated and actually visualize it? This brings us to the security market line, or SML for short. If you were to graph this equation out, you'd plot your risk, your beta, right on the x-axis, and your expected return on the y-axis. The starting point, the y-intercept, is your nominal risk-free rate, and the slope going up is that market risk premium. According to CAPM, in a perfectly balanced market, every single correctly priced asset should plot directly on this line.
And this brilliantly illustrates exactly how to spot a deal. If an asset is floating up there above the SML, it carries a positive Jensen's alpha. That means it's undervalued, it's offering you a greater return for its inherent risk. On the flip side, if it's sitting below the line, it is overvalued, meaning you are accepting way less return for the risk you're actually taking on.
Now for the really fun part, pricing an individual asset. This is our central focus, how we actually use the CAPM output to determine a real-world buy or sell decision.
It's basically a three-step quest to find an asset's true intrinsic value. Step 1, calculate your CAPM required rate of return. Step 2, use fundamental analysis to estimate the asset's future cash flows. And Step 3, discount those future cash flows back to their present value today using that exact CAPM rate we just calculated as your discount rate.
Once you've got that present value number in hand, the decision is pretty much just math. If your calculated present value is higher than the stock's current market price, boom, it's undervalued. But if the market price is higher than your intrinsic value, the asset is overvalued and you should probably steer clear. The CAPM discount rate essentially acts as the ultimate gatekeeper for this entire valuation process.
But wait, it all sounds a little too perfect, doesn't it? What happens when the real world gets messy and the market doesn't behave rationally? Let's look at some criticisms.
You see, CAPM is built on some incredibly strict textbook assumptions. It assumes we are all perfectly rational and totally risk-averse. It assumes zero transaction costs and zero taxes. It even assumes you can borrow absolutely unlimited amounts of money at the risk-free rate, which, hey, if only my mortgage broker agreed to that, right? Obviously, in the gritty, real-world trading environment, these frictions absolutely exist.
And because of those completely unrealistic assumptions, real-world data tends to, well, break the model. A glaring example of this is the low volatility anomaly. Empirical data actually shows us that low beta stocks historically offer higher returns than the CAPM formula predicts they should. On top of that, CAPM completely misses size and value effects, like how small cap stocks historically outperform. It just proves that using a single factor like beta is often a totally incomplete way to measure total risk.
The academic pushback on this is seriously heavy. In a famously blunt 2004 review, renowned economists Eugene Fama and Kenneth French stated, "The failure of the CAPM in empirical tests implies that most applications of the model are invalid." Ouch. They basically proved that the real-world relationship between risk and return is just much flatter than the model actually suggests. To deal with these glaring issues, modern finance has basically tried to fix the check engine light by expanding the whole model. Now we have extensions like the Fama-French three-factor model, which boldly adds size and value factors right alongside beta. You've got the consumption CAPM, and even behavioral portfolio theory, which actually factors in human psychology and mental accounting instead of just assuming we live in a mathematically perfect, efficient world. Which brings us to a huge, lingering question. Is a flawed model better than no model at all? Because despite failing numerous real-world tests, traditional CAPM remains a massive, foundational pillar of the financial industry. Its core logical intuition, that risk requires reward, makes it the ultimate baseline for determining asset returns. It's a starting block, not the finish line. So as you go out and evaluate your next asset, ask yourself, are you just blindly relying on beta, or are you truly looking at the whole picture?